Hi, I'm Jim Cunningham. Welcome to 1031 Exchanges, Know Your Options. I've got Christina Lindsey Orta here from Ascent Wealth Management joining me here today. Welcome, Christina.
Hi, Jim. Thanks.
This is very important. Disclaimer, Cunningham Legal is a law firm. Ascent Wealth Management is financial services. This is not legal advice, not financial service advice. Don't watch this and go do a bunch of stuff based on what we said, okay? This is information only. This is just part of educating you, really the consumer. So again, there's no offering of a real estate strategy. There's no legal advice. There's no financial advice. Very, very important. So what is a 1031 exchange? That is a reference to the 1031 is a section of the Internal Revenue Code. So in the United States, the Internal Revenue Code dictates federal tax rules, right? Most of the states follow them. That tax, California is one of those more heavily taxed states. And so they typically align themselves on most issues with the federal Internal Revenue Code. But what a 1031 exchange is you have a piece of property. You've got $1 million single family residence. You're tired of the tenants. You're tired of the property. You maybe depreciated that. Maybe you've had it 25 years. So you're starting to run out of depreciation, which I think is really common, Christina. And so what people do is they say, I'm going to sell this property and buy another one. And instead of paying the tax when you sell the property, you're able to exchange this property for another property and defer the tax. So the best thing in the world for when it comes to taxes are tax credits, right? The next thing is tax deductions. And then the next in the hierarchy is deferral of taxes, meaning you don't pay them now, you pay them in the future. And it's effectively an interest-free loan on paying the taxes. And then as with inflation, the tax bill in real dollar terms tends to go down over time. So this is
and the difference with this too, with the deferral is slightly different than with a IRA or 401k. With an IRA or 401k, someone is eventually paying the tax, whether it be through required minimum distributions. The inherited, beneficiary will have the 10-year stretch, but someone's eventually paying the tax. With a 1031 exchange, that asset under current law will get a step up in basis. So, this may be deferral during lifetime, but however, if the property is held in perpetuity up until death or death of the first spouse, the surviving trustee would then get the stepped up basis and be able to sell and avoid the tax entirely.
Yeah, I mean, that assumes, of course, that you're the owner that's not in some B trust and a bypass trust. We have a lot of
Correct.
On our YouTube page on that. So I would say on a general rule, when you die, you get an adjusted cost basis on your property for things that are included in your estate. What does that mean? It's things that the government would otherwise tax you on, right? So if you bought a house for $100,000, it's worth $1 million and you own it when you die, or it's in your living trust, your spouse can sell that. If it's community property, your spouse can sell that tax-free for $1 million. Your kids can sell it tax-free for $1 million. To your point, Christina, making that tax go away. Biden wants to change this. Okay. That's a fact. That's in the Treasury's Green Book. So maybe if you can talk about how a 1031 exchange works, Christina, with the qualified intermediary.
Sure. So essentially the way a 1031 process would start is once you've evaluated your options as to, does it make sense to do a 1031 exchange, and, consulting with your, tax accountant's attorney, as well as, your overall estate plan, as well as your certified financial planner, evaluating your options. Once you decide, okay, this is for me, the first step is going to be to list the property, just like you would in a normal transaction. You find a real estate broker, you list the property. Once it's listed and in escrow, so you've now got an escrow opened on the sale of that property, you then need to open up a qualified intermediary account, which is a 1031 escrow, if you will. That escrow is going to house the funds so that the funds never touch the client's hands. You can't have a traditional escrow, receive the proceeds, and then go decide to do a 1031 exchange. It has to go directly from one title and escrow on the sale of the property to a qualified intermediary.
Yes. So just, and Christina, you touch on a really important point. And, part of the purpose of doing this is to kind of walk you through how to do things and how not to do things. So if you have an IRA, there's a general rule that every 12 months you can pull all the money out of the IRA and within 60 days, put it into a new IRA. This is not an inherited IRA because you can't do that with an inherited IRA. That's a little bit different than the 1031 exchange, right, Christina? So in the IRA example, you can take the money out and kind of, you got 60 days to, go from financial advisor A to financial advisor B. With the 1031 exchange, this has to be set up before the close of escrow. And that's really important.
That is correct. And I do want to just make a quick statement. I know we had one person in the chat box just say that they couldn't hear. It seems like I can hear you just fine, Jim. You can hear me just
I think
fine.
it's probably, it's probably,
okay.
You want to turn up your volume or select your speaker. If you go into, of course, they can't hear me, but it's a function.
I think we're okay. Okay.
Yeah, we're okay.
Yes.
Can I just mention one thing about the qualified intermediary? Something I was shocked. I learned a long time ago that the qualified intermediary, this is an unregulated space. What I mean by that is Bob can open up Bob's qualified intermediary service and there's no licensing, there's no regulation. So I would seek out the qualified intermediaries who are reputable. Okay.
Yeah.
And that's really important. And typically they're attached with national title companies. There is a big one in Roseville, I think the nation's largest. So it's very important to pick out,
you just want to make sure that the intermediary is backed by a national title company that has insurance, because not all qualified intermediaries have insurance on the escrow exchange. So Jim and I do work with several intermediaries and we'd be happy to make referrals for our clients, but making sure that it's an insured qualified intermediary that's backed by a major title company is critical.
So let's look at an example here. A person sells a property for $1 million. The original cost was $100,000. We're assuming maybe it's a condo. I don't know, because there's no land value here. Depreciation, you have zero basis assets. So this is kind of an extreme example. So if you look kind of where it says no exchange cash, you sell it for $1 million. Your original cost was 100,000, but through depreciation, that 100,000 has been reduced to zero. And what's depreciation? The federal government says, the federal government pretends that if you own a single family residence, residential property, that property will fall down. The structure will fall down in 27.5 years, not 28 years, not 27 years, 27.5 years, and a commercial property, 39 years. That gives you a benefit of renting property out to third parties, right? To tenants. As a landlord, you get depreciation. So this has been a real benefit to landowners, is that you're able to reduce the overall income tax liability you have year over year. But the cows do come home on this, right? And that depreciation recapture is taxed at ordinary rates and a maximum 25%. In the federal tax, but Biden's proposing a 39.6% tax, right? Christina, on that 20 would go to 39.6. So this could end up being higher. The bottom line is you end up paying almost $400,000 in tax. Now, Christina, you and I have seen clients come to us after the fact. They say, oh, I sold it and I got my check. Yeah, I had to pay $400,000 in tax. And it's too late to do a 1031 at that point.
It is. And so what we wanted to walk through with this example is, if you do no exchange, if you just sell the property, pay the tax, bite the bullet, you're left with about $617,000 to invest. And what we're illustrating here is, if you were to do a 1031 exchange, you can either do a 1031 exchange into another like kind, and all a 1031 exchange is like for like, going from one type of real estate that's for investment purposes to another type of real estate. That could be buying an individual rental property and being the property manager all over again, or buying another building, or you could go into a professionally managed portfolio. And in a professionally managed portfolio, those are all paying around 4% cash flow. So what we do know is that in this low interest rate environment, cap rates are getting compressed, rents are coming down. However, when you're talking about taking that money, if you don't do another real estate exchange, if we have this $617,000 example and we have that left to go deploy and put it into a portfolio to generate income, it is incredibly difficult with traditional investment vehicles in the bond market when you've got a 10-year treasury government bond paying 1.3%. It is incredibly difficult to get 4% income on anything. Mind you, you'd be getting 4% if you're lucky on a $617,000 value versus if you were to do an exchange, not pay the tax, whether you do a direct exchange or go into a professional portfolio, you could probably get about 4%. And so that would be 40 grand a year on $1 million versus trying to get something close to 4% yield on less capital. So that's the real difference here is with the 1031 exchange is you've got more money available to generate the cash flow. And if you do go into another type of real estate, you're typically getting an appreciating type of real estate as well. So whether it be, again, a direct ownership or a professional portfolio that you're a shareholder in, that real estate is also appreciating in value more than likely, depending on obviously the due diligence done of what you're buying.
We have a question. Anonymous asks, I have 2 rental single family homes with my mom's revocable living trust. We both have 50-50 ownership in the properties. Could I do a 1031 with my mom's living trust with the end result being we each now have 100% ownership of one single family home? I have 1 property and the living trust has 1 property. I think you might be able to do that. We would need more information, but that's really what we're talking about, which is, if you want to kind of split the sheets with your mom. So this would be a 1031 where you buy each other out. Those have to be rental properties though. If you're living in one of the properties, and this is one of the catches here, if you're talking about a property that you're living in, that's not a rental property. You cannot do a 1031 exchange on your residence, right? So if those were 2 rental properties, I think that is probably doable. Again, it's not legal advice, but it's probably doable. But if it's a residence, you can't do a 1031.
And
So-
there was a key point that I wanted to address there on that question, because it's one of the things that I don't know if we have a slide that addresses it particularly, but it's a really critical point. If you own a property with another partner, whether that be, someone other than your spouse, if you own a property, and in this particular question, the client mentioned that it's a revocable living trust that she owns her a 50% share on title with her living trust and 50% share on title of her mom's living trust. That would be a scenario in which both investors, if you have on title 50% ownership with 2 different entities, they aren't tied to do the same thing. One could say, I want to go in and buy another single family home, be a direct owner. I like being a direct owner. I like doing the property management. One could say, I don't want to do that anymore. I don't want the cost of, having to put new roof, new tenant, carpeting every time I get a new tenant. I just want to go and be a passive investor. They could do a professional portfolio. They don't have to do the same thing. One could decide to pay the tax. One could decide not to pay the tax. So the difference being, if you have an LLC, and this is really where it gets complicated, sometimes we have multi-member LLCs. So let's just use this mother-daughter situation. Let's just say that they were one LLC. The LLC in its sole title, that was the title of the property. And they would then be beholden to doing the same thing. So that title has to go like for like. Now, if mom had her own LLC, daughter had her own LLC, and they were 50-50 on title, they could do their own separate thing. The problem becomes when you have multi-membership LLCs, that entire LLC needs to be unwound, and you would need to hold that property for a year or 2 before you could do a 1031 exchange and not have every partner beholden to the same thing.
The alternative would be the LLC could effectuate the 1031, but
Correct.
I would say the
yeah.
advice here, if there is advice, it's pump the brakes when there's an LLC that has basically is other than a disregarded entity. So other than like a single member LLC, you really need to take a pause and check with your tax professionals. And, part of this is about planning. It's you don't ready, fire, aim, right? It's you think about this, you get your facts, you get your data, you know what you're getting into before you get into it. Because too often I think people will take an action and then they go to their advisors, the ready, fire, aim. Then they go to their advisors and they say, okay, I did this. Now, how can I minimize tax? So Kelly asks, I'm a little confused. If I sell my investment property, can I take the proceeds and invest the proceeds into a real estate investment portfolio tax-free? Well, Kelly, I would say this. You can sell your investment property using a qualified intermediary. So this is not you taking the money. It goes to a qualified intermediary. You can invest that into a professionally managed portfolio of funds or another real standalone property, right? You can do that, not so much tax-free, but tax deferred.
Correct. When
you pass away, if that asset's included in your estate, your heirs inherit that property with a new cost basis. Okay. This is under current law. So it's a kind of a yes and a kind of no. I hope we answered that for you. And Anu asks, is there a limit on how many times you can do a 1031 exchange? No.
Currently, no.
No. Nope. So I've had a lot of clients build very large real estate portfolios using 1031 exchanges. And part of it, by the way, a big driver is that you run out of depreciation. So your property appreciates, you run out of depreciation, and your taxes start going up. And you're like, how do I save on taxes? Well, sell this property, buy another one with debt. Okay. That gets you more basis, and that allows you to depreciate more.
And the last thing I'll say on this slide before we move on here for a second, Jim's going to get into a little bit more of the nitty gritty on the process. But if you were to go into a professionally managed portfolio, what this is not illustrating is depreciation as well. So I want to be clear that if you go into if you buy another rental property, whether it be a single family residence or you're a shareholder in a professionally managed portfolio, there is a new depreciation schedule.
Right.
And so in the example I gave, if you're getting 4% on a professionally managed portfolio, if you invest $1 million of equity, you're going to get $40,000 a year paid monthly. That is net cash flow to the investors. Prior to that net cash flow, you still have your share of a new accelerated depreciation schedule. If you're a shareholder in an apartment building, that apartment building has a new 27.5-year, depreciation schedule. And you're going to have some of your income, you're going to have deductions against that rental income for mortgage interest if there's a mortgage on the property, depreciation. So those things still exist. You're still going to get some of the rental flow through onto your Schedule E of deductions, if you will. So it's just that we didn't highlight that because we're not talking about a product specifically.
Yeah. And Chris has a question. He says, you mentioned today and getting 4% return annually if you invest in a professionally managed fund. What happens 5 years from now? Are you still trapped into 4%, or will it grow to 5.5 or 6%? It's important to understand, Chris, that what we're talking about is this is a return that deals that are kind of coming out, they're reflecting a 4% payout. Correct. But it's not so much that it's paying 4% like some contract that says, I'm going to pay you 4%. You're getting the rents. Okay. So rents go up over time, and 4% of what? 4% of the value of the property as it is now. But in 5 years, the property that you purchased may in fact be worth more. Right. And so when these deals end, and Christina, what do you see industry wide, just speaking very generally?
Very generally, I'm seeing, rent increases. A lot of the, it depends on, again, the asset type. So in industrial, where you might have a triple net lease with Amazon, it's a long-term lease, maybe 2% annual rent bumps because it's, a triple net tenant like Amazon. And something that's multifamily, you're getting various rent increases based on the local market. That could be highly accelerated rent increases just due to demand in that particular submarket if it's an apartment building. But you are seeing whatever rent increases take place at the portfolio level are indeed passed on to investors. So that 4 would likely turn into 4.2, 4.25. It does typically go corresponding to the investor.
And then Anonymous asks, in a divorce, when I'm paying for my ex-wife to be in the residential property, can that be deemed a rental property? Well, that's a good one. We're selling it next month and I'm concerned about the transaction. What would I need to ask of my ex-wife? If possible, how can I save on taxes on a lived-in residential property? That's a complicated one, Anonymous. You do have it's either I would say it's either a rental property or it's not. And this is where I would talk to your financial advisor. You may have the Internal Revenue Code Section 121 exemption, which if you're a single filer exempts 250,000 in gain. And if you're a joint filer, even if it's your separate property, if you're a joint filer, you exempt 500,000 in gain. It's possible that that could take care of it. If you're the only one who owns that house, that's different than if your ex-wife also owns the house. Okay, so I would say on that one, that might be one where you would want to reach out to, maybe if like a lawyer, whether it's our firm or not, and looks at the decree, looks at the ownership structure, talks to your accountant. I think that you're going to know at least, what the tax consequence is. And I will tell you, Christina, I know that some of our clients get upset when they pay taxes. It doesn't even matter how much they're paying. Some people don't get upset, emotionally upset, but everyone is upset when they are surprised. Okay. So some people don't get excited about paying taxes. Other people, they turn red and they, want to, I don't know, go hit something.
Yeah. You want to make sure that with this particular one, you definitely, Jim and I refer to it oftentimes as the three-legged stool. You have your estate planning attorney, you have your certified financial planner, and you have your CPA. And this would be one that you'd want to run by all of them and make sure that whether you lived in it 2 out of the last 5 years, is that a better tax strategy than is it claimed as a rental on your Schedule E? What's the ownership structure? What's the divorce decree? So there's a little bit more complication there that you would probably want to seek counsel from all 3 of your professional partners.
Anonymous asks, if I do a 1031 into a professionally managed real estate portfolio, how does that pass to my kids? We will cover that.
Yep.
Susan asks, it seems this could really slow down the closing process for whomever buys my relinquished property. Is this typically a big problem? No, I don't think so. Oh, are you saying, Susan, that the fact of the 1031 would slow the closing process or the professionally managed portfolio of funds? I don't see that being an issue, Christina, do you?
No, it's typically also, if you do have a professionally managed portfolio in particular, does typically make it easier for trust administration upon death for heirs.
Yeah.
So I don't know if that's something that's of concern. I'm not quite sure.
And a lot of times what we see is, in order to defer, and as we'll see in a couple of slides, in order to defer 100% of the gain, you have to reinvest 100% of the proceeds. The problem is sometimes it's hard to reinvest every last dollar. You might get 80%. You're like, oh my goodness, I have another 20% left. And a lot of times people will take that nub and put that into a professionally managed portfolio as well. Patricia asked, I have an offer in hand on an investment property. Patricia, I hope it's a good one. When do I start the 1031 process?
Now, so you'd want to, as soon as you have accepted the offer, you're evaluating your options, you go into escrow. That is actually the ideal, perfect time to engage a certified financial planner, whether it be someone like myself, and talk about what your options are. Do you invest in another direct owned real estate property, or do you look at your options of professional managed portfolio, or a combination of the two? So the key is of the 1031 exchange timeline, what we're showing here is after you've closed escrow. So while you're in escrow and you have an offer on an investment property, you first again need to engage a qualified intermediary. Even if you say, okay, I'm going to have $1 million of net proceeds coming out of my exchange, and I want to take 200,000 and just pay the tax. I just want 200,000 of liquidity. You still want 100% of the $1 million to go to the qualified intermediary. Let them then distribute you some of the portion that you want to pay tax on, so that it never touches your hands until you're ready to pay tax. Once the qualified intermediary has those proceeds, so you've closed escrow on your investment property, title and escrow sends all the money to the qualified intermediary. That is your day one. Day one, you have 45 days to identify your replacement property, what you want to exchange into. And that could be, again, single family rental home. It could be, property one is a single family rental home. It could be one professional real estate, managed real estate portfolio. It could be 2 professionally real estate managed portfolios. So you could have a variety of exchange replacement property. You could have $1 million and you're putting 250 into, a couple different portfolios. And those portfolios just simply have to be identified by day 45, and the money has to be placed and go from the qualified intermediary wired to those investment properties on your behalf on day 180.
Yeah. So like day -15, before you sell your relinquished property, I get your qualified intermediary lined up. Day 1 is the date that you sell your property, right? The
Right.
property that is generating the taxable gain. The 45 days is like a stopwatch. So if on day 5, you identify a property, you stop the 45-day clock and you have 40 days to identify another property. So if that first property you identify falls out of escrow after 30 days, that you have 40 days left on the clock. So those are the day 45 is like a stopwatch. The day 180 is like a clock. Okay. So the stopwatch stops and starts. So going through the 3 basic steps, this is what we've been talking about: qualified intermediary, and the money flows through the qualified intermediary. It never lands in your bank account. You want to put some color on that, Christina?
Yeah. So the qualified intermediary, you're just going to have an escrow agent that's working on your behalf that will then you'll identify what you want to exchange into, and then they wire the proceeds to escrow for your exchange replacement properties.
So we have Charles. Hey, Charles, how you doing? He says a major problem with the professionally managed portfolios is that they do not have any contracted investment period. I've had several that advertised a 4 to 5 year period, but it's been over 10 years and still no liquidation event. Are there any vehicles that have a finite and contracted investment period? I'd say, Charles, if they were advertising a 4 to 5 year period, they shouldn't have done that, because I think that's too small of a period. But one of the things we're going to talk about is cost segregation. Cost segregation is where you change the method of depreciation. So instead of 39 years or 27 and a half, it's compressed to maybe 8. These have a natural life cycle or a natural lifespan of about 7 to 10 years. Especially if you're taking on debt, a lot of times an insurance company will lend money to the development, and they're going to have the note on maybe a 10-year note.
Yeah, most of the professional managed portfolios right now are 10-year notes. So
Okay.
they do have the intent of selling prior to that. Obviously, it's not a guarantee. I have not seen any as of late. REITs, yes, there's been some REITs and real estate investment trusts which do not qualify for 1031 exchanges. So REITs would not be something that you could invest in with an investment property from a 1031. There are, he mentioned DSTs. That is one type of a professionally managed portfolio. We're not going to get into specifics here on product, but there are some types of professionally managed portfolios that have, a targeted time frame of 7 to 10 years. Doesn't mean that they can't sell sooner if they see the ideal time to sell the property in 4 or 5 years. But I don't know that there's many that have gone beyond 10 years at this point in time.
Anonymous asks, what kind of fees can we expect for the services of a qualified intermediary? What are you seeing, Christina?
Typically around $1,000. So typically $1,000 is the average, what I'm seeing in the industry right now, that will allow the client to exchange into up to 3 properties. If they want to do more than that, then they typically charge, a per additional escrow wiring fees to go into more than 3 properties.
They also get a benefit of holding onto your money. So
yeah, so
that used to be a big, in a higher interest rate environment, that was a big deal. But anyway,
right.
So Anonymous asks, have you had a 1031 DST fail? An investor could lose their investment. I read an article during COVID. The loan on a commercial property was called, and the managers mismanaged the property, and the investors lost their money. You want to comment on that, Christina?
I have not seen that happen with any professional portfolios that we are working with respect to a loan being called due. I have not seen that. Now, there are thousands of different types of professionally managed portfolios out there that, some are regulated, some are not, some are registered with the SEC, some are not. There are various different asset types. And so I think that there's a tremendous level of due diligence that needs to be done. Diversification is key. What I will say is, when it comes to professionally managed portfolios that have been done, basically any of the portfolios that have come to market over the last 10 months, they've had a pretty significant and stringent COVID underwriting associated with them, at least the ones that we've done due diligence on and vetted. They are underwriting them ultra conservatively. When it comes to multifamily, What we have not seen, any of the ones that we have done business with, we have not seen on the multifamily nearly the amount of rent repayment programs that they expected due to COVID. They have actually increased rents. There was a couple that went down for a short period of time. They went down just to be conservative and keep extra reserves. And they've actually now made fully extra distributions back to clients and said that they didn't need to be that conservative. So if anything right now, if they're saying, hey, this might pay, 3.75 or 4%, the hope is, again, this is the hope that they're going to increase rents and distributions to investors sooner because they are conservative for COVID underwriting. Caveat to that, I will say I have seen one portfolio out there that I've seen that had 3 healthcare properties. And one of the properties, the tenant vacated during COVID and is not paying rent. And so the portfolio itself, it was an all cash portfolio. So there was no mortgage loan on it. And there's no loan being called due to COVID. I have not seen that on any portfolio that we've worked with, but the healthcare portfolio did have a decline in rent payments to investors because there was a vacant property. And that's where I think it goes back to making sure that you have diversification. I would not necessarily advise going into a healthcare portfolio right now. I think the main asset classes that we're seeing right now are multifamily. When it comes to professionally managed portfolios, we're seeing multifamily Class A that has high occupancy and high growth markets with low unemployment. So they're doing extremely well even in the COVID era. Self-storage has been a great asset class. Very low tenant improvement cost. Also industrial warehouses that typically have a triple net lease tenant, such as an Amazon, something along those lines. And then the only other asset class I would say is some assisted living facilities. But if you're sticking with right asset classes and diversification, I wouldn't go into healthcare right now. Then you're going to, do your best to mitigate those risks of having a rent reduction.
And just to look at this from a slightly different way. There is risk in any investment. Okay. And I'm not saying that to dismiss any concern about it, but my parents own single family homes and condos, not many, but they're like a lot of, they might have, 10 doors, something like that. Like a lot of people in the United States, smaller real estate investors, the mom and pops, think of the risk you're taking if you own 1 or 2 properties. What if that tenant doesn't pay rent? In a lot of cities now in California, you cannot evict tenants if they don't pay rent.
We've got a client right now in San Diego that's been trying to sell their property, and it's been actually an escrow, and they've got a squatter, and that squatter has not paid rent for 3 months. And this client relies on the income to pay her primary residence mortgage. So, there's risk in owning direct real estate. There's risk in owning, certain professional portfolios. You just really have to seek wise counsel, work with your CPA, work with your estate planning attorney, work with your certified financial planner, and figure out what's best for you.
So Anonymous asks, can you do a 1031 exchange for a rental property to a vacation home, which will be rented out? Now, I think if you're doing a 1031 on a rental and you're doing a 1031 into another parcel of real property that will be rented out on whatever service you're going to rent it out on, yeah, I think that qualifies. The issue then comes, well, can I stay there? So, I think that's something you need to work out with your spiritual advisor and your accountant. But that's where you're getting a little bit of a danger zone. So what clients have done in the past is they've actually maybe paid rent, right? You pay rent to yourself, but that's getting a little sketchy when you have personal use on a rental
Typically,
property.
you cannot use a rental property more for your own personal use if it is indeed a rental property more than 2 weeks out of the year. So vacation homes out of the question. Yeah.
So Marianne says, I own outright with no mortgage, a single family rental that I purchased for $300,000 and it now has a $15,000 basis. I plan to sell this property for $600,000. The first question, do I have to use all the proceeds from this sale and invest it in the exchange property, or can I invest it otherwise? I plan to purchase an exchange property of equal or better value than the property sold. 2, after selling it for $600,000, if I purchase an exchange property for $850,000, will my adjusted cost basis become $265,000? So I think the answer on that, you can do less than 100%, but as Christina said, you should have all the money go to the qualified intermediary, and then they can kick you move some money over to you, but it should go entirely through the qualified intermediary. And conceptually, yes, if you buy a property, you get more basis. Now the question becomes, and this is where you talk to your tax advisor, basis in what? Is the basis in the land, in the dirt? Is the basis in the structure? You cannot depreciate land. So
Right.
it's kind of a slightly more complicated question that, again, the three-legged stool involving your financial advisor. Chris asks, if you sell your house, I'm assuming your residence, for $1 million, can you say invest to $750 into a 1031 and then hold $250 and pay taxes on it? Yes, you go through the qualified intermediary, right? So you can do a partial 1031, but as Christina said, you're going to want to have all the money go to that qualified intermediary and then and get you some of that money back.
You just can't do it on a primary residence. So when you were talking about the 250 exemption, I don't know if you were talking about primary residence, you can't do it on a primary residence.
Yeah. So if it's your house, Chris, if that means if it's your residence for $1 million, you can exempt 250 or 500,000 in gain, and you can't do a 1031. So a lot of our clients in Southern California and the Bay Area, they sell their home and they move. They're kind of in a tax pickle, right? So
Jim, yep. Yep, there we go. So the qualified intermediary will enter into a written agreement with the investor. And they will be the ones to hold the proceeds in escrow or in their trust and make sure that the investor doesn't have the constructive receipt. So that's what we were talking about. Don't let the money touch your hands until you want to pay tax. And what we're going to talk about here is identifying the types of rules as to what you can exchange into.
Yeah. So you want to walk through this 3-property rule, the 295% rules?
Yeah. So this is what the qualified intermediary is going to give you as far as your identification papers of what you want to exchange into. So you can either, the 3-property rules that you can go into any 3 properties of any price anywhere in the United States. The 200% rule is that you can go into 4 or more properties as long as the combined value does not go over 200% of what the value of a property you sold. So if you sold property for $1 million, you can't go into more than 2 million. You can acquire and obtain debt. So I'm going to use the example of, let's just say you had $1 million property with 0 debt. You owned it all cash. You want to exchange into properties and buy properties worth 2 million and obtain, $1 million mortgage. You can do that. You just cannot go into a total value more than 200% of what you came out of. So 200% of the equity that you had, you cannot purchase more than that. And it allows you to go into 4 or more properties. And that could be 4 or more portfolios. 95% rule. That allows you to identify more than 3 properties if the fair market value of the properties is at least 95% of the replacement value. So you can't, if you have $1 million, you can't go less than 950. And so what I will say is on the 200% rule, some of our clients that do like to go into professional portfolios, it also allows them to get actually technically, potentially more than 4 properties because a single portfolio counts as 1 property. That portfolio could be 10 self-storage facilities. It could be 2 or 3 multifamily apartment buildings. So that's another way to diversify further is to, you're not limited to just owning, one individual single family residence and putting all of your eggs in that basket of that tenant being able to pay rent. So,
yeah. Christina, I was talking to a good friend of mine who's I'm 52. He's a couple years older than me. And we were talking this morning and the difference in mindset, building wealth, you take risk, you're willing to take risk because time's on your side, right? If the market dips, you can go. If you're retiring and you're in the phase of life where it's like, I don't necessarily want to build it. I just don't want to outlive my money. Mm-hmm. It really does require a mindset shift, and you really need to pay attention to risk. I believe that as you get older, you really need to pay attention to risk a lot more than you did when you were younger, and to be limited to 4 properties or 3 properties, that might be too much risk, right? But I will tell you, a lot of times I see people going from one property to another. They're not even doing multiple properties. So we have one question. Anonymous asks, if somebody purchases purchases an investment property using a 1031 exchange, how long must it be rented out before you can make it a primary residence? I don't know, 2 years. Maybe. No one knows.
That would be a consult your CPA and,
Don't email your CPA. Talk to him or her.
talk to your CPA, talk about filing at least, some tax returns that, whether it be 1 calendar year or 2 calendar years, that would be something I'd go through with your CPA and what your risk tolerance is.
Yeah, it's risk tolerance. And if the thought of being audited just makes you really nervous, there is a 3-year statute of limitations for a tax return. So that's kind of the, 3 years would be safe, I would say. So the new asset must be of greater value than the relinquished property.
Equal to or greater.
Equal to or greater. And the cash invested must be equal to or greater than the cash received from the relinquished property. So debt on property, this is where people can run afoul of these rules. If you buy a property for 100,000, it's worth $1 million, and you have a $700,000 mortgage on it and you sell it, Houston, we have a problem because you're going to have to pay capital gains tax on the money that you're using to pay off your debt. So you may end up negative.
Yeah. So for example, also, if you have a client that, if you have a property that is $1 million property and it has a $400,000 mortgage on it, you're going to net $600,000, just not factoring in closing costs and all that. Let's just keep it simple. You're going to get $600,000 in your pocket to exchange to go into another portfolio. You cannot take just that $600,000 and go into buy all cash a $600,000 single family home to rent out, even though you're only going to have $600,000 to work with. You previously had a 40% debt ratio. You had $400,000 mortgage. The IRS says in the like for like exchange, you have to carry equal or greater. The IRS doesn't care if you obtain more debt. The IRS says if you go from a property and then only have a $250,000 mortgage, you're going to pay tax on that $150,000 gain. You're getting a better deal, the IRS says, by having less debt on your books. So you have to keep equal or greater debt. And that's critical. Otherwise, you're going to pay tax.
All kinds of real estate, real property, right?
Yep. So there's all kinds of real estate property that you can go into. You can even go land to land. It just, most of the time people aren't doing land because it's not depreciable and typically doesn't generate a significant amount of income, but any type of like for like you can do in real estate.
Mark asks, is there any problem doing a 1031 with immediate family members? Do the transactions need to be at arm's length? Couple issues there. I would say they should be at arm's length. Once you start gaming the system, that's difficult. I would say immediate family members. If you're married and you're filing jointly, I don't think you can do that. I mean, I've never encountered that, but I would say it's best to talk to the tax professional on that one and the real estate and financial advisor. But I would say you could do it with immediate family, but the likelihood is you would want it to be an arm's length transaction. You have like gift tax issues otherwise, right? You have other issues. Anonymous asks, I realize completing improvements on a property within 6 months is challenging utilizing an improvement exchange. So what the Anonymous is saying is you can reinvest the proceeds in a property. So you have 2 properties, property A and property B. You sell property A with a gain and you take those dollars, your gain, and do an improvement, right? An improvement to property B. But if a married couple owns a living trust, 2 single family rental properties in the same quality California market, but property A needs significant redevelopment to realize the property's market value, can 100% of the sale proceeds of property B be tax deferred exchanged into the partial redevelopment cost of property A? Both properties have low loan to debt value and property B is fully depreciated. Does the answer change if the couple's 2 children inherit the same properties and wish to follow the same strategy? I would say, conceptually you can do that. But again, you got to have the details on that, right? I would say that's something to explore, Christina, and you explore that with your CPA and financial advisor and to see if it's a good move, because you may want to 1031 into a different property and get debt financing on the residence, right? It's just an economic analysis. I mean, even rental property, 30-year mortgages are under 3%. It's very cheap money. Any problem renting the replacement property to the son or the daughter? No. I don't see a problem with that. see a
Just
problem
claim
with
it as a rental,
Yeah, just claim it as
have a formal rent agreement, work with your CPA for sure. So one of the things on this is just trying to illustrate if you do direct ownership, or if you're just analyzing, quite frankly, your current property. If you have a property worth $1 million, a lot of times people will say, gosh, I just don't want to sell it. I'm getting good cash flow, but they really haven't analyzed the true ROI, the true rate of return that you're getting on that cash flow. So you might go, gosh, I'm getting a little over 22 grand a month. I'm getting $28,600 a year. I count on that income. It's part of my retirement income stream, or, it's good cash flow. I've got good tenants. But when you really factor in, okay, all of your costs, that's 2.8%, 2.86% of your total property value. And if that could generate you $40,000 a year, are you leaving some money on the table? And is it time to maybe look at a 1031 exchange and go into another portfolio that could potentially pay you more rent? So that's why I always encourage people to do a cash flow analysis, truly analyze your rent rates and your net ROI. And that means including the property maintenance. If you're putting in a lot of maintenance every year, or new carpet, new paint, new appliances, those add up.
Yeah, and we see this a lot, Christine, and I probably beating the drum on this as we age. I don't know, maybe it's just because I'm getting older, but as you age and you start thinking, this wealth creation, and I see clients in their 60s and 70s, and they say, the property is fully depreciated. I'm having to put a new roof on property. I'm having to put a new kitchen in, because these properties are old. Let's face it, if you've had a property for 30 years, probably has already had a new kitchen, right? So you're having to shell out a lot of money. And are you really going to recoup the value of that? I mean, that's right. A big question. And you may want to shift more to an income. You're a little bit more concerned in retirement about income, less concerned about capital appreciation. So cost segregation, let me just explain. Cost segregation is, as I mentioned, a change in the method of accounting. So this typically, to make it worthwhile, I would say you need about $1 million in basis. So if it's like 50,000 in basis, I'm not sure it's worth it. It allows accelerating the depreciation. So instead of a 27.5-year or 39-year depreciation schedule for residential and commercial and industrial, you compress that into a 7, 8, 9, 10-year period. So here's what you do is you reclassify. So if you have an industrial building that you're renting out to Amazon, and you say, look, there's a roof. Well, the roof normally has a 39-year depreciation schedule, but you know what? I think that roof needs to get redone every 8 years. So let's put that on an 8-year depreciation schedule. And the parking lot, that's on a 7-year depreciation schedule. And the plumbing, that's going to run out in 10 years or have to be replaced. We'll put that on a 10-year depreciation schedule. This involves engineering. This is real work. It's a real engineering study. And all this is fundamentally is a change in the method of accounting on a tax return. That's all it is. It's completely legitimate with the IRS. There's this hurdle of the cost segregation study to get you to that point. Now, I will tell you, Christina, what I've seen on every single one of these deals that we do. I have not seen in any deal that I've seen that you've been involved in, every single one of them has cost segregation.
Correct.
And the reason is that accelerates the depreciation for the investor.
The tax deduction, it's reducing some taxable income on the income stream.
So that 4% is about 70% tax-free.
Potentially,
it's another thing to think about, but that's what we're talking about. Let me say this about professionally managed portfolios of property. If you are selling a property for $2 million, and you're selling maybe a single family residence, maybe in the Bay Area or LA, you're selling it for $2 million. And you're like, I'm tired of dealing with these individual, single family residents. I want to get a commercial property. A $2 million commercial property is going to be probably nothing that you would even want to pull into the parking lot in. Okay, these $2 million commercial properties are C-class properties. You've got tattoo parlors, a dispensary. You've got these, wacky tenants. A lot of people don't want to deal with that. So what they say is, Christina, I've got this $2 million. I don't want to deal with the residential issue. I want to have the tenants basically taking care of their own space. 2 million isn't really enough. If you have 8 million, you can buy the dirt under a Chick-fil-A, right? And collect a rent check. But looking at these managed portfolios of properties, what are some of the benefits?
Not having to have the direct property management responsibility. So, and you might not already, if you have a rental property, you might have a property manager already, but this does really relinquish any property management responsibility. You're simply a shareholder. There's a professional managed portfolio manager, a professional property manager. They're determining the best time to sell that asset. They're typically going to offer a client geographical diversification. A lot of times our clients are, especially in California, they tend to, historically be cash poor and real estate rich and only have assets in California, which really can be a high risk when it comes to diversification. So that's some things that a professional portfolio could potentially offer a client is they just want to receive that monthly direct deposit and not have an additional call that they need to put in, $1,000 for this or $1,000 for that. They're just a passive investor.
I also like the limited liability. So when you invest in a diversified portfolio of properties, if there's a problem, they can't come after you personally. So that's a really big deal. Diane asks if the identified property falls out of escrow during the 45 days or during the 180 days, does the 45-day period to identify another property reset? No. So that 45 days, think of it as a stopwatch, right? And once you identify a property, you stop the stopwatch. You stop it. And then that falls out of escrow. And then it starts ticking again, that 45-day clock. So then you have to identify another property. And I will tell you, Diane, this can be really stressful because you don't want that big tax bill and you're starting to scramble. And I see this on the real estate side, real estate transaction side, when clients are selling properties. There's always somebody who's like, oh my gosh, I only have 3 days left to identify a property on a 1031. And there's, a little bit of panic mode.
And that's really why some of our clients actually will name a professional portfolio, even if it's a backup, because they may fall out of escrow. And especially in today's real estate market, we've seen that where it's a bidding war and they're going, gosh, I just can't get this offer accepted. And I really want these properties to exchange into, but we're getting outbid on every offer. So what am I going to do with all these proceeds sitting in escrow? I have to name something as a backup so that I don't have to pay the tax bill.
Yeah, this month is Real Estate Month at Cunningham Legal. We've got a bunch of content on our YouTube page. Subscribe to our YouTube page, by the way, to stay current. And we've been talking about this. It is a crazy real estate market. Now it's cooling down a little bit. We're in August of 2021, but it was not uncommon until very recently, and probably in some markets, to get 10, 15, or 20 offers on a property. That means, there's only one property and you're getting 20 offers. It may mean you have to bid on 20 properties. And if you're trying to effectuate a 1031 exchange, it can be a really stressful time for you.
Yep. The only other thing I mentioned on this slide here was the estate planning. So when it comes to, if you have a lot of rental properties and you have multiple beneficiaries of your estate plan, I'm sure you see this all the time, Jim, where you've got, 4 kids and, 3 kids want this property, the other kids want to sell the property. You have to retitle each of them. Or buy each other out. And so it gets to be complicated because the properties aren't of equal value. You've got people that want to do different things. Some things might be taxable, some things might not. When it comes to a professional portfolio, it is easier to administer most of the time. It's easier to administer the estate. We can just retitle the shares into the name of the trust and then to the respective beneficiaries. And then when the property sells, they can do their own thing. They collect the rent.
Yeah. I'm continually surprised how people, when the parents pass away, the family comes in, how oftentimes one sibling is still mad that the brother got the red Schwinn bike for Christmas in 1962 and he didn't.
Yeah.
So they're still mad.
Yeah.
Okay. Anonymous asks, is the gain associated with accumulated depreciation recapture deducted from the overall gain prior to applying capital gains tax rates, or is the accumulated depreciation subject to capital gains tax as well as a 25% accumulated depreciation recapture tax? Anonymous, there is an allocation. So the portion that is recapture of depreciation is taxed at a maximum rate of 25%. It's taxed at your normal income tax rates, by the way, but maximum 25. And then the other portion, the other appreciation, is taxed at a federal maximum 20% currently. So the answer to your question is no. The simple answer. Susan asks, what actually constitutes identification? Is it a contract in hand, a statement of sorts? Any thoughts on that, Christina?
It is actually a particular form that the qualified intermediary has. So that's one of the reasons why you want to have a good qualified intermediary. They are looking out for your best interest. They will give you that stopwatch and that time clock, and you have their paperwork that will be on file with them as the registrar, if you will. So they're the ones that are going to, make sure that all the I's are dotted and T's are crossed to make sure that you meet that 45-day deadline. And you have to have signatures that are time stamped and done by their timeline, and they have to have it on record to qualify for the exchange.
Anonymous asks, my daughter is going to college in San Diego. Congratulations. And they offer no on-campus housing after the first year. I was thinking of buying a property as a rental, rent it out to her and roommates. Then after a while, 1031 to a DST, let's say 4-year time frame. Is that possible? Yes. I mean,
Yes.
That's very common. That's very common. Yeah.
So what we should highlight too is just the potential drawbacks. Whenever you invest in real estate, there's inherent risks. Do you have a tenant that's going to vacate? Do you have, in California, you've got squatters with no eviction ability. Trying to recoup that rent could be difficult or costly. So, there's always that risk. It's illiquid in any kind of real estate, whether you own a single family rental property, you've got to sell that property. And again, we've got clients that are literally in escrow and they cannot sell that property because of squatters. And so whether it be a professionally managed portfolio and you're at the discretion of the property manager and portfolio manager, they may say, hey, we're thinking it's probably going to be ideal to sell this asset in 5 years or 6 years or 7 years. And you have no control over that. You are at the mercy of, truly, you want to make sure you're dealing with good professional portfolio managers, but you're at their mercy. And so you want to make sure you're picking a good professional portfolio manager that has a solid track record and that you're relying on good expertise.
It has to be a right fit too, because sometimes it is a right fit, and frankly, sometimes it isn't. Right. So there's a heavy dose of professional counseling, for lack of a better term, and that's a really important critical part to this, because this is a really big decision and there's a tremendous amount at stake. So let's talk about accessing institutional quality properties.
Yeah, so, accessing institutional quality properties, that's one of the things too that you can do with a fairly low cost of entry. So if you're coming out of a 1031 exchange and you've got a property in, California, that's a $750,000 rental property, and you have a $300,000 mortgage on it. So you're going to have, $450,000, maybe $400,000 after closing costs. When you sell, you're going to have, $400,000 of something to do with. That $400,000 isn't going to allow you access to a commercial Class A type building. So that $400,000, you could be a shareholder in a Class A institutional quality property. So that's another way to potentially get access to different types of properties that you would not normally be able to with less capital. Yeah.
I mean, like the Amazon store, the Amazon facilities. I mean, come on, they're going to pay their bill. My goodness.
That's an $85 million portfolio.
Yeah. If you have 85 million laying around, if you have access to those properties, right, that's one thing. But if you have 450,000, it might be something to consider. All right. Limited personal liability. I like that. It scares me to death to the thought of owning residential rental property in California, the rights, the bundle of rights. And we've covered that in prior webinars that are on our YouTube page.
Right.
So a few questions here as we wrap up. The inheritors of a professionally managed real estate portfolio are subject to the illiquidity of the direct investment horizon, which may be several years, versus inheriting directly on real estate and liquidating relatively quickly if so desired. Are they still bound by the terms of that, right? So there's still lockup essentially.
Yeah, so there is still lockup. I mean, now technically, there's no official secondary market. The portfolio manager will have the ability to accept a private transaction if they allow it. It's at the discretion of the portfolio manager, but there's traditionally no secondary market. So it is, if it is a 4 to 7 year lockup, that is what will ultimately happen is the professional portfolio manager trustee will then do an appraisal. So they might engage like a CBRE or someone to do an appraisal. And so that will establish the stepped up basis. And so the beneficiaries still get their step up in basis.
Mhm.
And so their shares will be re-registered with a new value. And when that property does sell, and let's just say that you're 2 years in and the property sells in year 5, you're only going to pay the capital gain from the date of death to the date of sale. And during the interim, the beneficiaries will have their respective shares registered in their name, and they'll collect the income stream. So yes, it is still illiquid.
But, again, I think you have 3 choices. If you own depreciated property that's driving you nuts that you want to sell, one choice is to do nothing and still be driven nuts. Okay. The second choice is to sell it and pay the tax. The third choice is to do a 1031, whether it's another property or some other professionally managed portfolio of properties. You may not like any of those options. Okay. But this is part of the counseling process. So Denise asks, any chance 1031 exchanges will be canceled? I understand the question, I think, is, will they be banned or prohibited? Well, what the Biden proposal is to limit them to basically $1 million. So it would be for the little mom and the little pops.
Or limit it to those that have $1 million of income. We've seen a lot of different proposals. So whether it be $1 million of property or $1 million of income, or, only being able to do so many exchanges, there's a lot of proposals out there.
No.
Ultimately, we have no idea what will get through Congress and actually become legislation, but it is driving a lot of exchanges to take place now, while we know we can get them done under the current law. But there's a lot of unknown.
So Anonymous asks, if we have a 1031 with a probable 10-year window, but Biden changes the 1031 laws, that will probably mean that when it's sold 10 years later, the taxes would be due. Any other obvious tax concerns on the horizon or predictable complications? 10 years is a long time. I think if you did a 1031 and then the law changed and you knew, oh man, in 9.5 years, we're going to have a big tax bill. You have 9.5 years to prepare for that. And there's a lot that you can do to mitigate capital gains taxes given enough time. So if you have questions, here's our contact information. We're online, CunninghamLegal.com. You can call us at those phone numbers there, or Ascent Wealth Management, or myascentwealth.com. And we've got our Northern and Southern California letter or phone numbers on there as well. And I want to thank you, Christina, for joining us today. I want to thank you for watching and joining us. And we look forward to seeing you guys again on another webinar or on our YouTube page. So again, subscribe to our YouTube page if you're watching on YouTube, and have a great day.
Great. Thanks, everyone.